This is what I wish founders knew before they shot themselves in the foot. Welcome back to the channel. I'm Sarah, startup advisor and climate tech investor. Today I'm sharing with you how to secure VC funding, and this is going to be particularly for climate tech founders. So we'll cover 10 non-negotiable criteria that will help you attract VCs and funding. As you may know, my background in tech over about the last decade has been in product design and growth hacking. In 2024, last year, I completely pivoted my business because I wanted to be part of the solution to climate change. This not only meant encouraging sustainable growth in tech, but it also meant putting my personal money into the future that I want to create. In 2024, last year, I invested in pre-seed and seed startups with a combined valuation of over 100 million US dollars. And this was alongside notable VCs like Lower Carbon Capital. I see a lot of founders struggling to get VCs to even respond to their cold emails. So I'm open sourcing my knowledge with all of you. Whether you are looking to raise money or even become an angel investor, we'll cover 10 non-negotiable criteria. It is a tough market right now, but when I see a founder is not getting a response, I always see a specific reason why in their pitch deck. It could be something like they're missing critical information, or perhaps they simply don't have a large enough TAM. Total addressable market. They could also simply be better suited to bootstrapping. So as I mentioned, I'll talk specifically about my experience investing in early stage climate tech startups. So keep in mind that that goes beyond software into things like hardware and deep tech. However, if you're a founder, you'll probably still find some of these are broadly applicable. So here are the 10 non-negotiable criteria for getting VC attention at the seed stage. The first one is going to be technical expertise. At least one founder needs deep technical knowledge. And realistically, actually, when it comes to climate tech investments, often both of the founders have deep technical knowledge. Sometimes they even have PhDs in their subject matter. VCs want to know why you are the right fit to solve this specific problem. And as I mentioned, both founders could be technical, but typically one founder will focus on the technical and one founder will focus on the business development. I have literally seen us pass over certain founders because they didn't have the right background for the technology that they were working with. Let's talk about 2, which is founder relationship. How well do you work with your co-founder? This is going to be really damn important. Red flags if you haven't built strong rapport with each other and strong communication. Expect to talk about how you met and your history together. Relationship chemistry matters. 3 is TAM, or total addressable market. Your addressable market must be large enough to support venture scale returns. It needs the potential to grow into something transformative that could return the entire fund. So what is the broadest potential market, the slice of the market that you can realistically reach, and the share that you expect to capture? 4 is going to be unique technology. Clear differentiation and defensibility is crucial. For example, can your product store thermal energy at a higher temperature than anyone else on the market? If your product is a replica of an existing one on the market or is really similar and there's nothing special about it, then it's a no-go. 5 is IP protection. You need patents or other strategies to protect your technology from competition. If another company can reproduce your solution easily, we have a problem. Keep in mind, one of the exit strategies is to be acquired by a larger tech company. This is a question that we ask every single time we see a founder pitch. It doesn't mean that they always have something, but often they have patents pending. 6 is going to be perfect timing. Articulate why now is the right moment for your solution. Has there been a recent policy change in your favor? Is your speed to market unique? And so forth. Too early is going to be just as bad as too late in climate tech. The graveyard of startups is filled with right ideas, wrong timing. 7 is going to be your go-to-market strategy. Show both your immediate entry plan and your long-term vision. This is looking at expansion beyond the niche. For example, maybe you have a specific material made out of mushrooms that you're going to start by focusing on just a specific application such as shoes. But the long-term vision is that you can go into any fabric. Climate tech especially requires thoughtful customer acquisition. The biggest challenge always with early stage startups is that no one knows you exist. 8 is TRL, or technology readiness level. TRL was developed by NASA as a way to understand the timeline to commercialization. So this is from basic concept to a market-ready product. And in between, you have everything, right? The development, the testing, and the scaling. Investors need to understand your risks and your timeline to commercialization. Too early and it's not a wise investment yet, and too late and we've missed the timing for an outsized return. 9 is traction and early validation. Even at pre-seed, we need to see something beyond just a deck. What have you done to build and validate? Where's the customer interest? Pilot projects or partnerships with established players give me confidence that you're not just in theory mode. Some of my investments from last year already had major partnerships with companies like BMW and L'Oreal. 10 is going to be capital efficiency and unit economics. Climate tech isn't just software. At least that's not where I think the big impact will be. I need to know that you understand the capital intensity of your path. Show me that you can reach meaningful milestones without burning cash like it's fossil fuel. So what are the essentials here? Remember, getting VC attention isn't about checking all of these boxes perfectly. It's about showing that you have thoughtfully considered each one and that you have a plan. Investors know that plans change. That's to be expected as a startup. Listen to the data and pivot when necessary. The best founders I've backed were self-aware about their potential and their weaknesses. Lastly, I want to mention, because I've made little shorts of this on LinkedIn and TikTok, and got a few people who were clearly founders that had at some point been rejected or maybe hadn't met all of this criteria. Just because you don't meet every single one of these perfectly, it doesn't mean that you are going to be disqualified from receiving funding. But the reason I share this with you is because you will be much better equipped to raise if you are aware and can speak to all of these points. So of course there will be edge cases. There are major investors who admittedly missed the boat on Airbnb because they just didn't see the market potential. So if you don't meet all of these, it doesn't mean that you're not going to get funding. It doesn't mean that you're not a great founder. This is simply what I put together in terms of how I observe VCs operating. And of course, the things that I look at when assessing a deal. What are your next steps? Are you a founder fundraising? Are you looking to start angel investing? Or are you looking to find product market fit? Share your experience in the comments below, and I will personally respond to questions and insights. If you need advising help, you can also reach out to me on LinkedIn. I only work with a handful of founders at a time. If you found this helpful, make sure that you subscribe to the channel and like this video, and I will see you in the next one.